Hey everyone, I have Ashley Abert here with us today. She is one of my tax advisors here at Gunderson's Bookkeeping. And we have noticed that with our own clients, we have a lot of clients who have put in shareholder loans and they don't have the correct documentation. And this is really important. If you get audited by the IRS, you want to make sure that you have this and you're treating it as a loan to the company and how you do that. So we're going to go ahead and answer those questions today of what is a shareholder loan, what a shareholder is, how to document it, and why this matters. So stay tuned if you think that you've loaned your company money and you're like, I don't know if I have or haven't. We're going to talk about it now. So Ashley,
Hi.
what is a shareholder?
So a shareholder is an owner of the company. So whether you're a partnership or a single member LLC, the shareholders are your owners.
Okay, so it could be myself, it could be my spouse, if I have a partner. Basically, if I own a company, I would be considered a shareholder.
Yes.
Okay. So why if I go ahead and put $10,000 into my company to get it started, um why do I have to have this documented? Um tell me more about that.
Okay, so a shareholder loan is really any money that you put into your company or I'm sorry, that moves between you and your company that isn't a salary or dividends. So it could be that you want to personally cover startup costs, or maybe there's a company bill that you're going to fund with personal funds. Um, or it could be personal expenses that you're paying out of your business. Any movement of money between you and your business that is not salary or dividend is a shareholder loan. And the documentation is important. It's because, first of all, it's for tax compliance. If the IRS sees undocumented transactions, they can reclass them as income and tax you on that income. And also, they provide audit protection. If you're ever audited, you want clear paperwork that shows that this was a legitimate loan. And third, it's clarity with your partners. If you have multiple shareholders in a business, you want good documentation to prevent arguments later down the road of who owns what. And finally, it keeps your financial statements accurate, which is crucial if you ever apply for financing or look for other investors.
Awesome. And you mentioned something, and it made me think of piercing the corporate veil.
Exactly.
Do you want to explain that, or do you want me to explain that?
It's up to you.
Okay. So, I just had a brand new client come in yesterday, and they're just starting a business, and I really made sure that he knew about piercing the corporate veil. And so the reason why you start an LLC is to protect you personally from being sued. It's all about liability, how big your risk is. And so I told him, if you have a bank account, a business, you want to open up a business bank account. If you need startup funds to get that company going, transfer the money into there. But again, it will be considered a shareholder loan. Say, 5 grand, 10 grand to get that company started for any expenses. And again, we'll talk about documentation next. And then, so keep business business. Keep personal personal. So on the personal side, say the business is doing well now, and you need to pay your mortgage. You need to buy groceries for your family, and you don't have the money in your personal bank account. What you do not do is swipe your business debit card to buy your groceries or to pay the electric bill. What you need to do, the correct thing to do, is you would go ahead and do an owner's draw. Unless you are an S corp, then you should be paying yourself a W-2. But all the other companies, besides a C corp, you would do an owner's draw basically. So if you have an LLC or a DBA, even a partnership, you're going to do a owner's draw or a partner draw and move that money into your personal bank account to pay your groceries, your light bill, the rent, whatever you need to pay. That's personal. And we're keeping business, business, personal, personal, because if you are going ahead and you are, say you have a personal credit card and you don't have a business credit card yet, and you're using a personal credit card, and it's all personal, it's all business, and you're commingling things, or you're, paying for personal groceries out of the business checking account, that is considered commingling your funds. And that is a big no-no. We do not want to commingle funds at all, because if you were to get audited and you're getting sued, the whole reason why you started the LLC was to protect your personal vehicles, your personal home, your residence, cabins, whatever the heck you have from being taken away in this lawsuit. If you pierce that corporate veil, the lawyer, I guess it's the judge is going to be like, well, you're not treating this as a separate entity. An LLC, your
Um,
business is a separate entity. If you're not treating it as a separate entity, they're like, why should we treat this as a separate entity for legal anyways? So if that corporate veil is pierced, that you risk all your personal stuff, you're being sued business side. So that was another thing that when you were talking about that, that reminded me of why we want to go ahead and document the money that you are putting into the company with a shareholder loan. Um, so, Ashley, say I put money into the bank account, into my business bank account to get started, or say I even, I started the business and I was doing a whole bunch of, I bought a whole bunch of things personally first and then put it into the business, and it could have been, with the state of Texas, it's a $300 LLC fee with the state of Texas. I had to pay for that because my bank account's not even open yet because I don't have an EIN
right.
number. So how do I cover those personal, even those personal expenses that I had to pay for personal before I even opened up the bank account? Talk to me about the documentation, please.
So the documentation is easier than you think. You really just need a simple written agreement that states the amount and the date of the shareholder loan, the repayment terms, and you can determine what you want those terms to be. And an interest rate. Even if it's minimal, it's very important that you do have an interest rate associated with that loan to make sure it looks and is acts as a shareholder loan and not just distributions that you're taking from the company. Um, and then keep your books updated, track your repayments, and if you add any new advances to your loan, include those, and so that you always know the balance.
Okay, awesome. When you say minimum interest, like, is that like 1% or 0%? Can I do that? The quick answer is no. A 0% interest rate, like no one in their right mind is going to borrow anyone's 0% interest rate. So it has to be a reasonable rate that you would lend anyone else, or the IRS is going to be like, or the judge is going to be like, no one would in their right mind borrow someone, $10,000 for 6 months, a year, 3 years at 0% interest. So that is key also. It has to be kind of whatever the going rate is. So if the going rate is 6% now, do a 6% rate. If it's 5%, and that's something that we can easily Google whenever the time is right. We really want to go ahead and charge that interest. We need to charge that interest, say at the end of each year, if you're paying it down or whatever. So we want to have an amortization schedule to go with that. And you can even put in there that it doesn't have to be paid back and for 5 years or until the business sells or when the cash flow is adequate. Or you can have it paid back over 20 years. Like whatever the terms are in that shareholder note, that we just have to stick with that.
No, I would just say a little bit of paperwork today can really save you from huge tax bills and disagreements tomorrow. So if you're not sure if your shareholder loans are documented correctly, you really need to talk to your bookkeeper, your CPA, and get that sorted.
Another key point is that this documentation has to be signed. So basically, if
Mm.
you personally are loaning your LLC money, you need to sign it that you agree with the terms, and then you, as the LLC manager, need to sign it that you agree with those terms too. So it needs to be signed too by all the partners and all the people lending the money too. So that's another key thing. So sign and date it. That would be very important.